This is Colin Cattell with Palisade Radio. We're back for another episode, and returning on the program today is Mike Swanson of WallStreetWindow.com. Mike's an author of several books, including Strategic Stock Trading, The New Gold Stock Investing Essentials, and The War State. Mike, thanks so much for joining us.
Oh, thanks for having me. It's a great time to talk because there's all kinds of stuff going on in the financial markets.
Yeah, I'm questioning where we should start here, but let's start with the Fed meeting that came Wednesday, where Fed officials were adamant that they would actually raise interest rates, yet they pushed that date back once again, stating that the inflation goal of 2% had not been met. What do you think is going on? Why they're not raising rates as quickly as they had said they would?
Well, one thing that happened this week, which was kind of interesting, was that on Monday on CNBC, there were economics reporter Steve Leisman did a story, and he's significant not because he's some sort of economics genius, but he basically gets leaks from the Fed and reports them ahead of meetings and so forth. And he said that the Fed was likely not to raise rates in September, and that they are, the way he put it, was data dependent, meaning they want to see more economic growth before they raise rates, and they're just kind of in a holding pattern. And he then suggested that they'll probably raise rates in December. So what that tells me is if current conditions don't really change, that's what they're thinking, that they'll probably raise rates in December. However, I think the conditions are going to change, and they won't, and that whole scenario will have to be thrown out the window. And what alarms me is I think the stock market will be dropping soon, and that will make them, not want to raise rates. Because last year the Dow fell about 10% in October, and there was actually talk, and again, Steve Leisman reported this during that October drop, that if the market continued to fall, that they would do another quantitative easing program within 6 to 10 months. The market recovered, went back up, but I think you'll see talk like that again if the stock market falls, and that'll just push the idea of rate hikes out the window.
You're close friends with my buddy David Skarica. He also believes that there is going to be a market correction, more of a market crash in his opinion, and it could be coming this fall. Can you talk about the internals of the market? Because one could claim with quite strong evidence that the market is actually already falling, and there's just a few large companies that are providing the optics that the market is still doing well.
Well, that's exactly what's going on. In the stock market, something about 60% of the stocks that trade on the stock exchange are below their 200-day moving average. Actually, most of these stocks fell below this 200-day moving average back in June, tried to bounce back above it and failed to do so, and started to come back down, which is very, very bearish. That's basically the setup for a bear market. So much of the stock market is falling. It's in a bear market and so forth. However, what happens at the end of a bull market is that exactly most stocks stop going up, the internals are bad, but a few stocks continue to go up and push the market averages higher, make them look good, so to speak. So in 2007, there's something like 4 stocks that were responsible for like 90% of the gain on the NASDAQ in a move from August to October. It was like Google, Apple, Amazon, and some other stock that's slipping my mind, but something similar has taken place over the past 6 weeks with Facebook, Amazon, Google, and then about 20 other stocks in the NASDAQ 100. And if you go through another example that anyone can do, I highly recommend people do this actually, because they will then see this for themselves. If you go and look at every one of the Dow 30 stocks, you'll see something very similar. There's 3 stocks in the Dow that have basically gone straight up the past couple months: Verizon, Disney, and then a third one too, slipping my mind. But outside these three stocks, about 7 stocks are kind of neutral, like they're floating around the 200-day moving average, and then 20 of them are below it, and some of these 20 are like really falling. A couple of them were falling on huge volume last week, so that's kind of what the entire stock market looks like. And you can look at this Dow 30, and if you were to then look at the S&P 500, Nasdaq 100, you would see the same thing. I'm going to explain to people how this really works, because a lot of people that listen to your show, are precious metals. They're involved in the precious metals market and mining stocks and so forth. If you think about that top in 2011 in the mining world, there's a huge, nice bull market from 2009 to 2011, big moves in gold and silver. However, in 2011, the mining stocks stopped going up. Gold really stopped going up, but silver blasted off over like 6 weeks and went up to $50. What is interesting is at the end of a bull market, that's often what happens. There's something or a few stocks or something like silver did that just goes up and captures everyone's imagination, and nothing else is going up. But what will happen is the person who's bullish will think, oh, well, this is so exciting, seeing silver go up. So that means everything's going to, even though it's not going up, hopefully it will. When in reality, this is the end of a bull market. And I think this leadership in a couple stocks that we've seen, about 20 stocks in the NASDAQ 100 is the end of the bull market. And what's troubling about them is a lot of these stocks have gapped up on earnings and fallen. If you look at Google, Amazon, and Facebook today, which didn't gap up, but most of these stocks aren't going up anymore. So I think it's just a matter of time now, and not very much time, before these factors just cause a big drop in the stock market. And I can't, it's even, the internal setup is actually in some ways worse than it was in October 2007. Now, I don't know if the market's going to crash overnight or just fall for several months, but I really have no way to predict that. But I just think that it's very negative, and at the very least, we're going to see, even a big correction, in the next 6 weeks or 8 weeks or something. Probably, I think it'll probably start next week, to tell you the truth.
I'm gathering from everything that you're saying that you don't expect a repeat of the 10% correction last year, but something much more severe than that.
Yeah, I mean, really, I think we're going to go into a bear market and fall all year long. And the average bear market is a 36% decline, at least since World War II. So, I mean, that's what I'm looking for, a real bear market, which is something, we haven't had since the end of 2009. We've had it in the mining stocks and gold. And that's the thing about bear markets, is they go on longer than anyone expects and surprise everyone, just as bull markets do. And I think in the long run, the United States stock market is, and really stocks in general, are vulnerable, because I think the world bond market made a top earlier this year, and we may see bonds do okay this year, or stay where they are. I don't really think they're going to make new highs or anything, but down the road, they could be forming this giant top and then falling in a year or two in a big way. And so that would be like a second bear market if that happens. But I'm just really looking for a typical bear market decline, which again is about 15 months, 36%. And if you look like at the 1962 stock market, bear market, that's what it kind of did, was it formed a top and just went down for like 8 months. Oil is actually another good example. What happened with oil last year and this year, I think that's a good model for what's likely to take place. If you look at the XLE ETF, it peaked out last year and fell really hard in December, and people tried to buy that, and now it's touched the lows again. This week, it actually looks like it's going to break them to me. So that's just the kind of stuff. It just bear markets happen. You can't really predict. The exact. I'm not an LA wave theory guy, so I can't claim to predict each. How it's actually going to play out. To perfection or something. It's just that when the general trend changes, it's down. When it was bullish.
Mike, the negative correlation between gold stocks, and the general equities presents a pretty nice investment opportunity if you believe there's going to be a market crash. Our friend David Skarica, he's actually buying put options and some short ETFs on the market because he's very, very convinced that there's going to be a sell-off, as are you. How are you playing the current opportunity that there might be a crash in the general equities?
Well, I personally don't really I'm not really an options trader, so I like to just short individual stocks and also use the short ETFs that trade opposite to the U.S. stock market. So that's primarily what I'm doing. I'm already starting to position myself that way. I started doing it this week, actually. Now, to give you an example, the returns in a bear market when you're positioned right can be huge. Even if you're using options, I mean, you can really rack up. But even if you just do individual stocks, they can be pretty big. And the reason why is bear markets are very volatile. The stocks go down faster than they go up. So if you take, for example, one of these short ETFs, you can basically put a stop on them within 4%, 3% of their 52-week low right now. And you'd be looking to make, if the market falls 36%, you could be making 70% or 65% or something. So that's like 20 to what you're risking. I mean, now it takes more money to buy the ETFs than it does options, but it's just all figuring out how much money you want to use and how much you want to risk. The good thing about the options type situation is you can have a long portfolio full of all these stocks that everyone likes and just use a small amount of money to buy put options on different things to hedge that portfolio. So that's one tool you can do, because a lot of people really feel uncomfortable to be selling and going into. Honestly, I think that's a good thing for most people to do, because another way to benefit from a falling market is to be able to be in a position to buy after the decline's over with.
I'm looking at the homepage of your site, WallStreetWindow.com, and thank you. You've posted the precious metals market update that we do at Palisade Radio with Jordan. Jordan has been spot on the last few weeks. He was calling for a bit of a crash, maybe a last crash or second to last crash in these gold stocks before we enter the next stage of the bull market. What do you think is going on with the gold stocks, and what do you see playing out, especially if there's a market crash in the general equities?
Well, one thing about I think the ramifications of a bear market are going to be good for gold and the mining stocks. They may, in fact, be about the only thing that really goes up in commodities in general too. But the timing of that's really tricky because look, I mean, I'm someone that restarted to be looking for a bottom in gold stocks about early last year. It hasn't come. Like you're saying, Jordan was someone, he was looking for this more of a decline, and he's gotten it. So what is coming next is a big question. And I think that first of all, the stocks are obviously extremely oversold from a historical standpoint. If you look at Jordan's presentation, he shows that to you in there. The Commitment of Traders report is also at an extreme contrarian point. Now, it's to me, so it's the price action. And if the stock market falls, we're going to get a more dovish talk, at least, about the Federal Reserve, which will help gold, help the mining stocks. If you saw last Monday when gold crashed, or the mining stocks crashed, they're down 10%. There are all these articles on the internet saying gold is done forever because basically the stock market's never going to fall and Fed policy has been mastered, is what they were saying, and it's not going to go up for years. And obviously, if the stock market falls, all that these people are saying is not true at all. And as far as the timing goes, if you look, I think there's two real possibilities. One, it is extremely oversold. We fell last week hard, and often when a market is in a bear market and you get a 10% down day, that is the bottom. So there's a potential that it just turns up soon and just goes higher and just starts the bull market. However, there's also a possibility that initially when the stock market drops, and I don't think it's going to like crash overnight, I think we're going to see more of a bear market unfold from now and for a year or something, not like an overnight crash. But the first leg down of a bear market, it's possible that the mining stocks stay under pressure. They could even make another low or something. But at some point, they would start to hold up against the decline in the U.S. stock market, and then that would be a sign they're getting ready to turn up and break out. And at that point, I think they would just go totally crazy to the upside. So an example of how this kind of played out, a situation like that, was in the year 2000 during that bear market. The stock market, the Nasdaq topped out in March, but the Dow and S&P 500 didn't really roll over until about Labor Day in September. Then everything went straight down to January. Well, when that fall dropped, the mining stocks were under pressure, but they bottomed out around October and then went up for years. So that's kind of something I'm open to, that possibility that that they don't actually go up immediately as the stock market falls, but go up after a couple of weeks of it falling or something. But either way, I think everyone who wants to make money on the long side of the market or long side of something needs to stop looking at Google and Facebook and the stocks they talk about on the television set and focus more on looking for the turning point in gold stocks and gold itself. And it's just a matter of time at this point. I don't really think they're really downside. In a downside scenario, I think the gold stocks would hold their recent lows and just have one more drop of 5% or possibly 10%. Probably just create a V bottom and just go up. So, there's nothing wrong with having a position that you hold. In fact, I have a core position that I'm holding in case it just takes off. So my advice is people interested in that market have some sort of position. You can't really count on getting the exact bottom, but then also to be prepared to buy more.
Yeah, well, a chart that just went up on that precious metals market update with Jordan was the bear analog chart. And if you haven't seen it before, it's a little bit confusing, but what it shows is that by price decline, this bear market in gold stocks is now the worst ever and second worst ever in terms of time. And what that means is coming out of this bear market, when it does end, it's going to be spectacular on the long side. So on that note, I want to thank you so much for coming back on the show, Mike. I would urge all of our listeners to go to WallStreetWindow.com and sign up for Mike's free or paid newsletter. Mike, thank you.
Yeah, thanks for having me. Great talking with you.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
And the world is always going to need raw material. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, troll, did you hear what's going on in Yemen, or are you too stupid?